Hello, and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial Group. If you'd like more information about what you hear during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialgroup.com. And while at my website, click on the podcast page to check out our past shows and to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. Okay, so the Tax Cuts and Jobs Act of 2017 reduced personal income taxes for many Americans, but it expires on December 31st, 2025. If Congress doesn't act, taxes could rise for many households. So, while no one can predict the future, Congress will have actually three choices and to extend the legislation as it is, adapt it, or allow it to expire. But without an extension or other changes, income taxes will likely go up for many of us. And to add another wrinkle to the situation, the federal exemption for gift and estate taxes will be cut nearly in half if Congress doesn't act. So, during our show today, we're going to discuss the Tax Cuts and Jobs Act of 2017 and what its possible expiration could mean for you and your financial strategy. But before we get into that timely topic, let me introduce my co host, who I'm pleased to report, Tony Shore, has a contract that we keep him on well past 2025. Tony, how we doing, buddy?
Well, yeah, I'm not going anywhere, Albert, as long as my voice
Good.
holds out. We were talking
Yes.
before the show. That's right. As long as my voice holds out, I'll be doing the show with you. But I'm not going anywhere, but the tax cuts might be going somewhere. Unfortunately,
Definitely.
they might be going away and
Yeah.
taxes will probably be going up. So I'm glad we're having this conversation, but I've been great. Thanks for having me on your show once
Oh,
again,
of
Albert.
course.
How about you? What have you been up to?
Just getting ready for the holiday, long weekend we're going to be having, doing
Yeah.
yard work like everybody else and
Yep.
getting things just in order. But that's it. And, enjoying the weather. It is finally getting nice.
Yeah.
Well, for us,
Yeah.
that is.
Yeah. Yeah. It's been rainy elsewhere. There's a lot of flooding going on, but we've had a couple of nice days
Okay.
here. Fortunately, last weekend when I was moving my daughter and doing yard work, it was just beautiful. I mean, there was a
Oh,
nice cool breeze. It was in the mid to upper 70s and
yes.
gotta love that. But I know some people might be worried about what the Tax Cuts Act expiring could mean for them.
Yes.
So, what do you want to do to begin? Where do you want to start here?
Let's start with the Investopedia article. What is the Tax Cuts and the Jobs Act, or what we used to call TCJA? It basically explains the legislation and what it's meant for many Americans. And so let's just take it at the basic level right now. The
Sure.
Tax Cuts and Jobs Act of 2017 was a massive overhaul of the federal tax code that took effect in 2018. In fact, it was the largest piece of tax reform in almost 3 decades, Tony. And it created a 21% flat corporate tax rate, which was permanent.
Mm.
However, numerous tax cuts for individuals were temporary, thus, the need to keep an eye on how Congress choose to handle the legislation's potential expiration at the end of the next year, Tony.
Yeah, and I think I remember some of those brackets and cuts specifically, but can you go over the details for us?
Sure, sure. Well, the legislation was obviously very thorough. First, it changed numerous tax rates. The top tax rate dropped from 39.6% to 37%. Then the 33% tax bracket went to 35% bracket was also left unchanged. Oh, I
Oh,
should also add that the 10% tax bracket is the lowest that was unchanged as well.
yeah, yeah, okay, yeah. So, yeah, and the 33 went to 32 and the
Right.
28 went to 24.
24.
That's
And
a
then
big one. The 28 going to 24 was really big,
that
right?
actually was, and then even 25 to 22 was a good jump, and then,
Yeah.
obviously we have our 15 to down from 12 to 12,
Yeah.
so that made it a 10% jump from there to 22.
Sure. So if you're in one of those brackets then Albert, your taxes will go up the end of 2025 unless Congress takes additional measures, right?
Well, basically, Tony, Congress has to either extend the act or pass a similar legislation. Otherwise, those brackets will automatically go up. And once the act expires at the end of this next year. Now, let's discuss also some of the legislations of other elements to it. The legislation also increased the standard deduction. So this year, the standard deduction is $14,500 or $600, I should say, for individuals and $29,200 for married couples. So the Tax Cuts and Jobs Act of 2017 also got rid of personal exemptions through 2025 as well, Tony.
So, what's the personal exemption?
Well, the personal exemption was a $4,150 and was available for every taxpayer. Now, while the legislation ended this particular deduction, it made up for it by modestly increasing the standard deduction.
Yeah. Yeah, and I'm glad the standard deduction, especially for couples, went up there.
Hmm.
That's good. And I'm probably stating the obvious here, Albert, but if any of our listeners out there are concerned about what the expiration of these Tax Cuts and Jobs Act could mean for them, I think
Right.
the first step should be to reach out to someone like yourself, a financial services professional. So I encourage our listeners to do that. Now, also, tell us about the Affordable Care Act's individual mandate, how that fits in here.
Yeah, I mean, when the Affordable Care Act was signed into law, it included tax penalties for people who neglected to buy health insurance. But the Tax Cuts and Jobs Act of 2017 eliminated that requirement.
Hmm.
Now, the legislation also increased the child tax credit to $2,000 and created a $500 credit for non child dependents. But both changes will vanish if the legislation is allowed to expire at the end of next year. Now, the estate tax is also a big issue here.
Yeah.
The legislation increased the estate tax exemption tax, and this year it's a maximum of $13.61 million per person. Now, like every other part of the Tax Cuts and Jobs Act of 2017, that will expire at the conclusion of 2025.
Yeah. And when you say a maximum of 13.6 million, what do you mean?
Well, basically, it's the maximum amount of an estate that you can transfer to a beneficiary before the estate tax is triggered, Tony. And that means if you have an estate worth, let's say, $14 million, your beneficiary would only be required to pay taxes on $390,000 of it.
Gotcha. So let's imagine a hypothetical then where the
Okay.
Tax Cuts and Jobs Act is allowed to expire untouched. They don't change anything. What happens then?
Well, rates would return to what they were before the legislation was signed into law, which was $5.49 million or $6.9 million when adjusted for inflation. Now, using that same 14 million estate as an example, you'd pay taxes on a little more than half of it. And if you have a significant estate, you should closely monitor how Congress handles the legislation in the months before its possible expiration. And once Congress has made its final decision, whatever it may be, well, you should review your entire financial strategy with your financial services professional.
Yeah, and speaking of that, Albert, why don't we let our listeners know how they can get a hold of you?
Yes, listeners, you can visit my website at www.kaizenfinancialgroup.com. That's Kaizen. Or you can call my office at 586-752-7008 and discuss how we can answer your questions and address the concerns about the Tax Cuts and Jobs Act of 2017.
Right. And you're also offering our listeners out there, Albert, a no charge, no obligation consultation. You've got you and your staff team there are great. I want to give that number again in case our listeners want to get a second opinion on where they're at or get a
Sure.
first opinion or a plan in place for their finances, their investments, their retirement accounts, and get a full retirement income plan in place. That number is 586 752 7008. Now, we've been talking about this Tax Cuts and Jobs Act of 2017, which
Right.
is set to expire, you've told us, at the end of 2025. And if that happens, it likely means taxes will go up for many Americans, though Congress hasn't indicated whether it's going to try to extend the legislation,
Mhm.
revamp it. There is still time for them to act, but they don't act swiftly or often. So,
Never, never.
so what's next? What do you have next for us
Well,
today?
let's continue our important conversation here about taxes by next addressing some tax strategies for retirement withdrawals. The tax implications for retirement withdrawals are one of my clients' biggest concerns. So, we're going to refer to a U.S. News and World Report article titled How to Pay Less Tax on Retirement Amount Withdrawals. And it's got some good insights here. The first piece of your strategy should be ensuring that you avoid early withdrawal penalties. If you begin taking money out of your traditional 401k before you reach age 59 and a half, you could be staring at a 10% early withdrawal penalty. And essentially, that means you're just giving a chunk of your money away. But you may be able to begin penalty free 401k withdrawals when you turn 55 if you leave the job linked directly to that specific account. And additionally, it may be possible to avoid the IRA early withdrawal penalties if you utilize the money you take out for an approved expense like medical bills or college costs or even buying your first home, Tony.
Yeah. Well, and I think working to devise a retirement strategy that's thoughtful and broad
Mhm.
is a great reason, again, to work closely with somebody like yourself, Albert. And speaking for myself, I think retirement withdrawals are so critical to my overall retirement strategy. For my wife and I, you don't want to begin them before you get an opinion from a financial professional.
Oh, I
Uh,
would I would agree.
yeah. So, what else do you have for us?
Well, in some cases here, let's say you may also be able to roll your 401k over without tax withholdings. In fact, here's an example here. Let's say you take money out of your 401k when you change jobs, Tony. Well, in this scenario, 20% may be withheld to cover income taxes. Then, if you don't quickly put the entire distribution, including the 20%, in a different retirement account, you could be slapped with income taxes on top of an early withdrawal penalty for what you've just taken out. So, however, how you want to avoid that is you want to be able to avoid both the tax withholding and those possible penalties and fees if you directly transfer the money from your 401k to the trustee of a different 401k or let's say an IRA. Income taxes are then not held, or trustee to trustee transactions is what help keeps that from being out of your hands, Tony.
Yeah. Yeah, that's interesting. So how do RMDs or
Ooh.
required minimum distributions fit into all
That's a
this?
very good and very important question, Tony. As many of you listening right now likely know, you're required to withdraw money from traditional 401ks and IRAs once you hit your 73rd birthday. Now, the penalty for not making an RMD is 25% of the total that you should have taken out. And don't forget that the penalty is in addition to the income tax that's also still required on the withdrawal. Now, luckily, if you notice the error and promptly correct it, the penalty may drop to as low as 10%. And furthermore, if you're still working after you've turned 73 and you don't own 5% or more of the company that employs you, well, you're permitted to continue delaying the 401k withdrawals from your current company until you officially retire. But be aware, though, that this doesn't apply to IRA withdrawals. Also, note that the RMD age will eventually rise to 75 on the first day of 2033.
Okay, so an older RMD, even if the change is still a number of years into the future, is probably a factor that many people listening out there will want to discuss with a professional, a financial professional, a fiduciary like yourself, who's going to help them based on their situation figure out what to do. You don't want to make a costly mistake there.
Definitely, you're absolutely right. In fact, you should next be next careful to not inadvertently also take 2 distributions in 1 year. People make that mistake. In fact, you must take your first RMD no later than April 1st in the year you reach age 73. But from there, your next and every subsequent RMD is required before December each year. So let's say you delay your first distribution until the following year, April, because you have that grace period for the very first distribution. But then you could end up taking 2 distributions in that same year, Tony,
Mhm.
which may mean a heftier tax bill or a nudge into a higher tax bracket. And then be sure to sit down with both your financial service professional and tax professional to discuss strategies for taking your first and second RMDs in different years.
All right. Well, we're going to keep rolling along and move into our final segment here. And you've been talking about how we can avoid paying too much taxes on retirement withdrawals. That's
Mhm.
been good. What do you have next for us on the agenda?
Well, let's finish with the U.S. News and World Report article, How to Pay Less Tax on Retirement Account Withdrawals. It has some more details I think our audience will find pretty interesting, Tony. So let's begin by saying sending an IRA distribution to one of your preferred charities is another option you should discuss with your financial service professional. Those who are at least 70 and a half could avoid paying some income tax on IRA withdrawals of up to $100,000 for individuals and $200,000 for couples annually. Now, if they donate it to a charity, obviously. Now, a qualifying charitable donation must be paid directly from your IRA to the qualified charity. You aren't required to itemize your taxes to make an IRA charitable distribution, and you're allowed to donate to more than one charity. In fact, an IRA charitable donation also satisfies your minimum distribution requirement. And then finally, Tony, you're also permitted to send a percentage of your RMDs to the charity of your choice and then withdraw what's left over as income. Now, I'd suggest discussing these strategies with both your financial service professional and your tax professional.
Yeah. And you've said before on previous shows, Albert, that some of your clients have charities,
Mhm.
churches, nonprofits that are really important to them. So, going into more detail about this option with your financial professional again, or a tax professional seems like a solid move.
It is. In fact, dedicating a portion of your retirement savings to an after tax Roth IRA may help supply you with the tax free investment growth and tax free withdrawals during your retirement. And while you won't enjoy, let's say, a tax deduction in the year you contribute to a Roth IRA or a Roth 401k, well, you won't be required to pay the income taxes on the investment growth of that account as well. And withdrawals during your retirement from an account that's minimum 5 years old are generally tax free. Now, also, if you think it's possible that you'll be in a higher tax bracket after you retire, then a Roth account may be one of the best ways to hang on to your current lower tax bracket.
Yeah, and I know you've been very big on the Roth, and it is a great way to have tax-free income in retirement. But Roths might not be right for everyone. Is that correct?
That's exactly right, Tony. While it's true that Roth IRAs and 401ks often offer certain advantages, they won't automatically fit into everyone's financial strategies. For me, the largest possible risk is that when you dedicate money to a Roth account, whether it's a Roth 401k or a Roth IRA, you're anticipating that you'll be in a higher tax bracket after retirement. But here's the essential question: what if you don't end up in a higher tax bracket during retirement? Well, obviously, you want to pay taxes on your money when your rate is the lowest. For example, if you're currently in the 22% tax bracket, but it's looking like you'll be in the 12% tax bracket during retirement, well, you're saving much less. There are more possible disadvantages that you should discuss with your financial service professional, however, prior to making any of those choices, Tony.
Right. And again, the bottom line is don't make any financial decisions about Roth IRAs, traditional IRAs, 401ks, or any other major part of your financial strategy without first talking to your financial professional, a fiduciary, somebody who's going to look out for your best interests like yourself. Now, what do you have for us next?
Well, having tax advantaged investments outside your retirement account is also another way you may be able to save more money when you take retirement withdrawals. So, those investments that produce long term capital gains receive special tax treatment when established outside a retirement account. But if you place them in a retirement account, well, then you'll pay your standard income tax rate on the money you take out of your account. So, conversely, you may shrink your tax payments by maintaining more highly taxed investments, like, let's say, Treasury inflation protected securities, or we call it TIPS, corporate and government bonds, and funds that provide short term capital gains within your retirement accounts. Now, an important note here, I don't get too far into the weeds about investing during our shows normally. We don't have, obviously, adequate time to fully address the rules, regulations that govern investments. However, I will say that if investing is part of your strategy, then you should only do so when working with a financial services professional, Tony.
Yeah, and I think we're going to close on that note. We're almost out of time for today's show, and that's really good, Albert. How can our listeners do that? How can they get a hold of you to talk about this?
Folks, you can visit my website at www.kaizenfinancialgroup.com. That's Kaizen, Kaizen. Or you can call my office at 586-752-7008 and discuss how we can answer your questions and address your concerns about the Tax Cuts and Jobs Act of 2017, your retirement goals, and any other parts of your financial strategy. So remember, it's our goal to help you prepare for the retirement you've worked so hard for so you can own your retirement.
All right. Thanks, Albert. And listeners, thanks for tuning in. That does it for today's episode of Own Your Retirement with our host, Albert Lalonde.
Take care, everybody.